Hello everybody, welcome to class 4. I hope everybody is fine, doing well during these difficult times. And I hope everybody is staying at home, following the new laws. Yeah, it's difficult for everybody, but we still need to go on. So let's go on. Today we'll talk about making adjustments to the trial balance. Last lectures we first started with a simple transaction analysis, and then we learned how to journalize specific transactions and then how to post them into the ledger T accounts. And also we learned how to prepare a trial balance. Today we will talk about making adjustments to certain accounts in order to complete our trial balance. So first of all, we will start with talking about two types of accounting systems that can exist. The first one is the one that is used in all over the world. Is called accrual basis accounting, and in accrual basis accounting, adjusting process is used to recognize revenues when earned and expenses when incurred, and the expenses are matched with relevant revenues. If you remember, we talked about revenue recognition and the expense matching principles before. This way, business performance is better reflected, and it also increases the comparability of financial statements across firms and over different years. And another theoretical accounting system is cash basis accounting. It recognizes revenues when cash is received and records expenses when cash is paid. It's not used in any country, in any accounting system. The one that is used is accrual basis accounting. So the main difference is in accrual basis accounting we don't wait until cash is paid. So we can recognize revenues and we can match those revenues with the relevant expenses. Whereas in cash-based accounting, theoretically, you should wait until cash is received to recognize certain revenue. And cash is important for a business. That's why there is a separate financial statement called cash flow statement or statement of cash flows. And also a year, the time period assumption, as we call in accounting, is important. Accounting time periods are generally months, quarters, or years. Some companies prepare like maybe daily financial statements for internal company purposes for the managers. They usually prepare monthly financial statements, quarterly, and governments require that companies prepare yearly, annual financial statements. An accounting time period that is 1 year in length is a fiscal year, and a fiscal year can start at any date. Usually it's the first day of a month, any month, and finishes 12 months later at the end of a month. Most businesses use calendar years, which is from January 1st to December 31st, but there are certain companies that use fiscal year that starts at a different date than January 1st, depending on their on the nature of their business. So recognizing revenues and expenses. At the end of accounting periods, companies need to make necessary adjustments, and when making those adjustments, two principles are used. The first is revenue recognition principle, We actually talked about them before. Revenue recognition principle states that revenues are recorded when earned, not before or after. So earned means that, for example, if you are selling a physical product, you need to make sure that the product has been shipped, sent to the purchaser, or if it's a service, you have provided the service to the user. An expense recognition or expense matching principle means that expenses in the same accounting period are matched with the corresponding revenues in the same period. Matching of expenses with revenues is the major part of adjustment process, and for that purpose we use certain predictions and estimates, and it's also a very important thing in accounting that companies can get advantage of revenue recognition and expense matching to make to show that they have more profits or less profits, and there are a lot of accounting scandals because of this. But now that's not the purpose of our discussion here. So what is the adjusting process? Adjusting entries ensure that revenue recognition and expense recognition principles are followed. And adjusting entries are necessary because the trial balance may not contain up-to-date and complete data. This is true for several reasons. So the trial balance that we've been preparing, does not always show all the available information. We need to make adjustments in order to include all the necessary information from accounting point of view. So the reasons why some information could be missing. Number one is some events are not recorded on a daily basis because it's not efficient to do so. Examples could be supplies and the earning of wages by employees. So supplies are purchased at the beginning of, let's say, a fiscal year, and then they are used, and at the end of the fiscal year, at the end of the period when you are preparing the financial statements, you make an adjustment how much of those supplies you used. Also, wages are like not they are accumulated, and at the end of the accounting period they are paid, so you don't make accounting adjustments every day for wages. Number two, some costs are not recorded during accounting period because these costs expire with the passage of time rather than as a result of recurring daily transactions. So, examples can make it clear. There are charges related to the use of buildings and equipment, rent, and insurance. So we talk about insurance prepayments. You pay for insurance in advance and you make adjustments after you use the insurance policy. And number three is some items may be unrecorded. An example is a utility service bill that will not be received until the next accounting period. So even the utility bill is received after the current accounting period finishes. Because this utility bill is an expense, because it belongs to the current accounting period, you need to make the necessary adjustment. Okay. Let's move on. So, what adjustments are to be made? Adjustments are needed to properly measure two things. The first is net income or net loss, which of course appears on the income statement. And the second is assets and liabilities on the balance sheet. So again, So if you look at the graph, you'll see the 4 types of adjustments that we need to make, and they are divided into categories: paid or received cash before expense or revenue recognized, or paid or received cash after expense or revenue recognized. If something is paid, let's say before it's been recognized, we have like prepaid expenses, we have unearned revenues, and if something happened after expense or revenue recognized, we have accrued expenses, accrued revenues. We'll see more what they are in the forthcoming slides. Okay. So the first is prepaid or deferrals, they're also called prepaid expenses. What are prepaid expenses? Prepaid expenses refer to items paid for in advance of receiving their benefits, and in accounting we consider them assets. So even though like you hear the word expenses, they are considered assets, so they appear in the balance sheet in the left hand side of the balance sheet under assets. So examples can be prepaid insurance, prepaid rent, and etc. Prepaid insurance: when you buy an insurance policy, you pay in advance. Let's say if you buy insurance for your car, you pay in advance for half a year or for 1 full year, and you pay in advance, and that's for you. That's going to be an asset. Prepaid rent: you pay for your rent at the beginning of the month. It's only expense at the end of the month when you use like the apartment for the whole month. But at the beginning of the month, it's prepaid rent. So at the beginning of the month, it's asset. At the end of the month, it is going to be an expense. For example, this is the explanation, right? At the financial statement date, insurance expense account is debited, which means that an expense is recognized, and prepaid expense account is credited, which is prepaid expense account is an asset account. So if an asset account is credited, means that the amount decreases. One example is a company called Pioneer Advertising paid $600 for a 1-year fire insurance cover. So if we divide 600 by 12, we'll get $50 per month is the insurance expense for this company. So we assume that the company paid the insurance, the $600 at the beginning of October, and if the company tries to prepare its financial statements at the end of October, then what you are seeing on the graph will happen. So let's go over the graph. So basic analysis, on the left side you see basic analysis. So the insurance expense is increased by $50, and the asset prepaid insurance is decreased by $50, as I told you. And the equation analysis, on the asset side you have prepaid insurance, which is an asset item, that decreases by $50, and the owner on the right hand side, liabilities plus owner's equity, insurance expense, which is recognized $50. So debit credit analysis, debits increase expenses. So this is the journal entry, insurance expense is recognized $50, and credits decrease assets, so we credit prepaid insurance asset account. And when we are posting, we will do it this way. Prepaid insurance, which is an asset account, decreases by $50. That is the adjustment we make for the month of October for Pioneer Advertising. And for the insurance expense, we recognize $50 insurance. So if you still don't understand what we are doing here, just go back to the previous classes, the PowerPoint presentations that I gave you, that I sent you. You can see, if you look through those presentations, you'll understand that what I'm trying to say. A prepaid insurance is an asset account, and we used $50 of that asset, so we decreased it. When an asset account decreases, we credit it. So at the end of October, for that period, you have a balance of $550. So $50 of the insurance premium that you paid, you used during October. And insurance expense is an expense account. So when we have an expense, we debit it. So that's why we debited it here and we credit it here. Okay, let's move on. Supplies, another adjustment that we need to make. Supplies is like you purchase different supplies for use during the accounting period, and you don't make, like, you don't count them as expense every day. That's why you make a whole purchase, and at the end of the accounting period you make your accounting adjustment. So this is one example. So at the end of the accounting period, you recognize $1,050 of supplies expense, and you credited here $1,050 supplies means credited, which means that from the initial purchase you decreased, you subtracted $1,050, which means that you used $1,050 of supplies during this accounting period. And this is how we post them. Expense, we recognize $1,050 expense at the end of the accounting period. That's an adjustment, and that goes to the income statement. And the next is supplies asset account. We decreased by $1,050 at the end of the accounting period, and that together with this information, the balance of $8,670 goes to the balance sheet. So what does these numbers say? So on December 2nd, this company purchased $2,500 of supplies. On December 6th, $7,100 of supplies purchased, and on December 26th, $120 of supplies purchased. And during this month, the accounting department made their calculations and found out that $1,050 of supplies were used during this period. Alright. Any other prepaid expense, such as prepaid brand, is accounted for exactly as insurance and supplies. So these are prepaid expenses. And then another adjustment that we need to make is depreciation. Depreciation, I hope that you have heard about this before. The definition is, this is a systematic allocation of the depreciable amount of an asset over its useful life. Because of wear and tear, passage of time, and obsolescence, non-current assets lose their value over time. When companies buy plant assets such as buildings, machines, vehicles, and fixtures, they don't show the purchase price as an expense. Instead they put the purchase price on their balance sheets, and every year for a certain period of time they depreciate it. This means that they subtract depreciation expense from that purchase price for several years. One exception is that normally land is not depreciated, so just keep that in your minds. That for how long the asset, non-current asset, will be used is called useful life, and the value at the end of that useful life is called residual value, salvage value, and yeah, it's an estimate. You cannot be sure how much the residual value of a non-current asset be. You just make your estimate. Okay, so we'll look at two different methods of depreciation. One is maybe the most popular one is called straight line method. Straight line method assumes that depreciation occurs evenly over the life of the asset, so the asset is written off in equal installments over its useful life. Formula for straight line depreciation is the initial cost. You can see it here. Initial cost, the purchase price of the asset, minus its residual value, divided by useful life in years. So that will be your annual depreciation, and that number that you will get after using this formula is called your depreciation expense for the year. Example, a welding robot is bought by a car manufacturer for 200,000 pounds on the 1st of January 2008. It costs $40,000 to install the robot, and it is expected to be used for a period of 10 years, after which it is expected to be sold to an industrial museum for $4,000. Calculate the annual depreciation. I didn't make the calculation, but I will tell you this. So the purchase price of the robot is 200,000 pounds, but also the cost of installment should be included to that purchase price. So here under cost, you'll have to have $240,000 pounds minus the residual value, which is 4,000 pounds, which is an expectation, an estimate. You cannot be sure about that. So 240,000 minus 4,000 divided by useful life of 10 years. So that number, after you make the calculation, will be your annual depreciation expense. And the next second, maybe most popular method is called diminishing balance method. And the diminishing balance method, the basic idea is this. The accountants assume that some items, some non-current assets lose more value during the initial years than in later years. So this way they have higher depreciation in earlier years and lower depreciation in later years. Okay. So basically this method works by applying a given or calculated percentage to the net book value, the value that the purchase price, up to the date of the calculation. So I mean each year you decrease the value, the book value of the non-current assets by a certain percentage. So one example is company X paid 12,000 pounds for a car for a sales manager on January 1st, 2007. The depreciation rate is 40% per annum. Show the depreciation on a diminishing balance basis. So for example, for the first year, your depreciation expense will be 40% of 12,000 pounds. For the next year, 40% of the 12,000 pounds minus the depreciation for the first year, and for the third year it's 12,000 pounds minus the depreciation for the initial first 2 years, and 40% of that amount, and so on. So when after calculating depreciation, you need to make two adjustments. One is the depreciation expense. So depreciation expense, the amounts that you calculate will go into the income statement as a depreciation for that accounting period, for that year. And the value of the non-current asset adjusted for depreciation is included on the balance sheet. Depreciation decreases the book value of the non-current asset. So for the calculated amount, you decrease the book value of the non-current asset.